Today, walking the uncertainty tightrope towards who knows what next. Hello again, it's Martin North from Digital Finance Analytics, with latest posts covering finance and property news. Well, this is our weekly market update, where we start in the US, cross to Europe and Asia, and end in Australia, covering commodities and crypto on the way. To remind my loyal viewer, this is a data-rich show as I get the week developments into perspective. Think of it like the shipping forecast for the markets. Market trends are rarely linear for long, and they naturally ebb and flow. Despite the flaring conflict in the Middle East and the US election just a month away now, the MSCI's Global Equities Index rose on Friday, though for the week it showed roughly a 0.7% decline, while the Dow closed at fresh record highs and the US dollar climbed to its highest level since the middle of August as investors heaved a sigh of relief after a surprisingly strong US labour market report. The US Bureau of Labour Statistics said 254,000 workers were added to non-farm payrolls last month. That's way above the 140,000 that economists had estimated. The 4.1% unemployment rate was below estimates, while jobs growth in August was revised higher. Average hourly wages rose by 0.4% on a monthly basis. That's faster than predictions of 0.3%, but slightly slower than an upwardly adjusted August mark of 0.5%. Question is, will this be revised later? And we will see, though, that the closely monitored jobs opening and labour turnover survey showed that available positions, that's a proxy for labour demand, rose to 8.04 million in the final business day of August, climbing from an upwardly revised tally of 7.71 million in July. So taken at face value, this is a blowout US jobs report, Mohammed El-Arin said in a post on X. All headline data points are notably better than the consensus forecasts. On a standalone basis, this implies not just a solid, but a strong labour market. Continued US economic exceptionalism, a good reason for the Fed to push back more against the markets, forcing it into the single mandate, maximum employment, policy box, and less aggressive market pricing for 2024 to 25 Fed rate cuts. Actually, Fed Chair Jerome Powell signaled earlier this week that the central bank would likely opt for more traditional quarter reduction moving forward, but stressed that the future path of rates was not preset. Powell added that the rate-setting Federal Open Market Committee is not in a hurry to cut rates quickly, despite announcing an outsized 50 basis point drawdown at its September 17th and 18th gathering. Chicago Fed President Austin Gussy described the jobs report as superb and said it was still appropriate for the Fed to bring interest rates down a lot over the next 12 to 18 months. And he added that the central bank's policy rate remains well above an eventual settling point, and it would likely need to be ratcheted down over the next year to a year and a half. In response, US Treasury yields rose to their highest level since early August as traders ditched bets that the Federal Reserve would cut rates by half a percentage point next month. The yield on the 10-year Treasury surged to 3.98 in New York, and we think it could go well above 4% actually. The 2-year note, which typically moves in step with interest rate expectations, rose to 3.924% from 3.71% late on Thursday. Likely bringing further relief to markets was the reopening on Friday of US East Coast and Gulf Coast ports after dock workers and port operators reached a wage deal to settle the industry's biggest work stoppage in nearly half a century, which is expected to result in a wage hike of around 62% over 6 years. However, clearing cargo backlog is expected to take some time. Goldman Sachs' top US equity strategist David Kostin signaled he's more bullish than ever on the outlook for corporate profits as investors await a wave of third quarter results beginning late next week. The Citigroup Economic Surprise Index turned positive this week for the first time in 5 months. Actually, investors' opinions diverge though. Many think that the 6,000 for the S&P 500 is not only within reach, but is too easy to reach, while a few others, like Apollo's CEO, think that the Fed has no reason to keep cutting rates and that its aggressive U-turn could backfire. All up, bullish sentiment expectations that stock prices will rise over the next 6 months slipped 4.2 2 percentage points to 45.5% in the last week. But bullish sentiments above that historic average of 37.5% for the 47th time in 48 weeks says there's still upside, maybe. On Wall Street, the Dow Jones Industrial Average rose 0.81% to 42,252, registering a record closing high, but just 0.9% up for the week. The S&P 500 climbed 0.9% to 5,751, and the Nasdaq Composite advanced 1.22% to 18,137. The Volatility Index, that measures the implied volatility of the S&P 500 options, was down 6.25% to 1921. The best performer of the session on the Dow was Boeing, which rose 2.98% to $155 at the close. The worst performer of the session was Home Depot, which fell 0.78% to $408.36. In the corporate sector, Spirit Airlines stock slumped 25% after Bloomberg reported the carrier's attempt to restructure its debt and avoid filing for bankruptcy had hit a snag after talks with bondholders failed to result in a deal. And Rivian Automotive stock fell more than 3% after the EV manufacturer slashed its full-year production forecast and delivered fewer vehicles in the third quarter than expected as the startup grappled with a parts shortage. Canada stocks were also higher at the close as gains in the IT, energy and financial sector led shares higher. At the close in Toronto, the S&P TSX Composite added 0.81% to hit a new all-time high. In currencies, the dollar, clearly reacting to geopolitical risk, jumped to a 7-week high and was eyeing its biggest weekly gains since September 2022 after the jobs report led traders to cut their bets on big Fed rate cuts. The dollar index, which measures the greenback against a basket of currencies, including the yen and the euro, rose 0.56% to 102.49. Oil prices rose and settled with their biggest weekly gains in over a year on the mounting threat of a regional-wide war in the Middle East, but gains were limited as US President Joe Biden discouraged Israel from targeting Iranian oil facilities. Investors remained anxious about how Israel will respond after Iran fired missiles added on Tuesday. But oil prices pared gains after US President Biden said that in Israel's shoes, he will consider alternatives to striking Iranian oil fields and that he thinks Israel has not decided yet how to respond. US crude settled up 0.9% to $74.45 a barrel, and Brent settled at $78.08 a barrel, up 0.55% on the day. US gold futures fell 0.35% to $2,673 an ounce. And ahead, on one hand, its long-term outlook remains bullish thanks to Chinese investors and central banks still buying, and Indian demand is surging for this year's key wedding season. However, on the other, after surging dramatically in the last couple of months, gold's sell-off risk is actually quite high. Massive recent buying not only catapulted gold deep into extremely overbought territory, it exhausted gold futures speculators' likely capital firepower for buying as well. Couple that with October's normal seasonal pullback, an oversold US dollar, and excessively dovish Fed rate cut expectations, and gold is staring down a large pullback, if not a correction. Gold's powerful surge over the last couple of months was largely driven by massive gold futures buying. Speculators in that realm punch way above their weights in bullying around gold prices due to the extreme leverage inherent in it. Each contract controlled 100 ounces of gold worth $265,000. But margin requirements are super low. Absurdly, those traders only require to keep $11,000 cash margins in their account for each gold futures contract they trade. That makes for extreme maximum leverage to gold of 24.1 times. Way up there, every dollar deployed in futures has 24 times the price impact on gold as a dollar invested outright. But the risks are insane, as a mere 4.2% gold move against speculators' positions wipes out 100% of their capital bet. Now, over in Europe, the UK FTSE ended flat on Friday at 8,280. Best performer of the session was NatWest Group, which rose 3.88% to trade at 342.50. The worst performer for the session was Spirix Psycho Engineering, which fell 3.39% to trade at 7,120. In the corporate sector, JD Witherspoon stock rose 0.5% after the British pub chain reported a hefty 73% rise in annual pre-tax profits, with sales topping £2 billion for the first time. British Finance Minister Rachel Reeves said that she would introduce guardrails to ensure that extra borrowing for investment in her first budget is not excessive, as she seeks to reassure investors about an expected rise in public debt. Reeves is due to make her first tax and spending budget statement on October the 30th. That's a milestone for the new Labour government of Prime Minister Keir Starmer, who has promised to increase investment in areas such as infrastructure and the transition to a net zero economy to speed up Britain's economic growth. With public debt at around 100% of annual economic output, investors are waiting to see how much more borrowing Reeves opts for, alongside some tax increases. British gilt yields have risen more than those in other government bonds in recent weeks, partly due to concerns about the scale of extra debt sales. At the same time, the warnings about a tough budget have dented consumer confidence, casting a shadow over the first months of the new government. And the former Bank of England economist confirms that she plans to revise the government's fiscal debt rule to take account of the benefits of investment, not just the costs, but declined to say how much extra spending those changes would allow. And elsewhere, the Governor of the Bank of England, Andrew Bailey, signalled rate cuts could come faster than originally thought. The main European indices struggled during the early days of October as the tensions in the Middle East have escalated. They were largely unchanged on Friday, ending the week on a cautious note with the DAX in Germany flat, while the CAC 40 in France just up 0.1%. French industrial production rose 1.4% in the month of August. That's an improvement from the drop of 0.5% in the prior month. The best performer in the session on the DAX was Siemens Energy, which rose 3.39%. And the worst performer was RWEAG, which fell 1.96% to 31.46. The DAX Volatility Index, which measures the implied volatility of the DAX options, was up 5% to 1930. The euro was down 0.5% to 1.0976 against the US dollar. The market anticipates the European Central Bank has less dovishness than the Fed and will deliver less than 80 basis points worth of rate cuts by the beginning of 2025. Therefore, if US data continues to come out stronger than expected, while the Eurozone data disappoints, a large adjustment in monetary policy expectations may well take place. Recent stimulus measures introduced by the Chinese government have bolstered European stock markets, but not enough to turn around Bank of America's negative outlook for equities in the region. In a note to clients on Friday, analysts at Bank of America noted that the Pan-European Stock 600 has rallied by roughly 2 to 3% to a fresh record high since the measures were first announced, with China-exposed sectors outperforming in particular. European luxury groups, which rely heavily on sales in the lucrative Chinese market, were particularly beneficiaries. In September, Beijing unveiled a sweeping package of new policies, including an outsized cut to interest rates and a reduction in existing mortgage costs, as it looked to reinvigorate China's sputtering economy and teetering housing sector. However, while the support policies may provide a boost to China in the months ahead, Bank of America suggests that the magnitude of the growth remains murky, adding that they still see downside to the Eurozone manufacturing and services activity. Our macro projections are consistent with rising equity risk premia and deteriorating earnings expectations, implying nearly 50% downside to the Stock 600 in the second quarter next year, and a 10% renewed underperformance for European cyclicals versus defensive, the analyst wrote. Over in Asia, China was on holiday, but the Shanghai Shenzhen CSI 300 was up 8.48% over the past week, and the Shanghai Composite was up 8.06% over the same period. The Hong Kong Hang Seng rose 2.82% to 22,736 and was up more than 10% over the past week. Japan stocks were higher on Friday. At the close in Tokyo, the Nikkei 225 added 0.16%, and the Topix was up 0.39%. Shares in Japan's steelworks rose to 5-year highs, up 4.12% to 5,605. The Nikkei Volatility Index, which measures the implied volatility of the Nikkei 225 options, was down 4.13% to 2509. And the US dollar Japan was at 148.71. India's Nifty 50 fell 0.93% to 25,014. The best performers of the session on the Nifty was Infosys, which rose 1.31% to trade at 1,918 at the close, while Oil and Natural Gas Corporation added 1.1% to 295.20. The worst performers of the session were Mahindra and Mahindra, which fell 3.59% to trade at 3,017, while Bajaj Finance declined 2.99 to end at 7,209. And Nestle India was down 2.87% to 2,599. The Australian share market snapped a 3-week winning streak on Friday as the escalating conflict in the Middle East sent traders fleeing equities and pulled shares down from record highs touched a week earlier. The S&P ASX 200 ended Friday 0.7% lower at 8,150 points, dragging the score to a weekly loss of 0.8%. That's the first since early September. Of the ASX's 11 sectors, 9 ended the session lower. Traders fled equities and bid up oil prices after US President Joe Biden said overnight on Thursday that the US was discussing a potential retaliatory attack on Iranian oil assets by Israel. Oil prices surged more than 5% following those comments, but of course they were walked back later. Woodside gained 2.2% to $26.64, and Santos was 2.1% higher at $7.30. Smaller oil and gas players also benefited. For example, Horizon Oil, which has gas and oil projects in New Zealand, Papua New Guinea and China, rose 7.5% to 21.5 cents. Miners were the worst hit amid signs the previous week's rush towards the sector, sparked by renewed stimulus efforts from the Chinese government, was losing steam. BHP fell 1.7% to $44.58, and Rio Tinto 1.9% to $3.02. Banks also declined. Commonwealth dropped 1.4% to $132.74, and Westpac was 1.9% lower at $30.14. Small cap tech developer Electro-Optical Systems added 5.1% to $1.55 as traders bet that rising tensions in the Middle East could mean more demand for its defense technology. In July, its revenues soared in the first half because of a rise in weapons systems ordered by an undisclosed Middle East client. Shares in Light & Wonder rallied 7.8% to $140.69 after the gaming company said it intended to develop a new version of its popular Dragon Train game following intellectual property dispute with Aristocrat Leisure this year. Regal Partners added 2% to $3.55. The asset manager has topped $17 billion in funds under management as its takeover talks with fellow wealth giant Platinum Asset Management advances. And the two groups will enter due diligence this week. Platinum shares added 1.7% to $1.23. Fellow asset manager Magellan Finance fell 3.2% to $9.62 after reporting $200 million worth of outflows during September. Bonds moved higher with the 2-year Cangro at 3.793 and the 10-year jumping to 4.195 as prospects of imminent rate cuts got kicked out further. On the currency exchange, the Aussie dollar was back down to 67.97 cents to the US dollar and 51.77 cents against the UK pound. The IMF this week gave a mixed assessment of recent government budgets and whether Treasurer Jim Chalmers and his state counterparts were helping the RBA to tame Australia's worst inflation outbreak in decades. They warned the federal and state governments that any further unexpected rise in spending will force the Reserve Bank to keep interest rates high and that future cost of living relief needs to be targeted in its annual health check of the Australian economy. It also suggests the government phase out $52 billion worth of superannuation tax concessions and the $19 billion capital gains tax discount to fund a reduction in personal income and company tax rates. With the Albanese government considering scaling back negative gearing and the 50% capital gains tax discount, the IMF said there was a case to reevaluate tax concessions paid to property investors as part of a broader package designed to address Australia's chronic housing shortage. The IMF said the federal government's decision in May to give $300 energy rebates to every household may inject some additional stimulus into the broader economy and called for household transfer payments to be targeted wherever possible. The federal government's electricity bill rebate, as well as similar subsidies recently announced by the Queensland and Western Australian governments, are paid to all households rather than just vulnerable ones. Echoing similar comments from RBA Governor Michelle Bullock, the fund said electricity rebates only temporarily lowered headline inflation and did not affect underlying price pressures. The IMF endorsed the RBA's restrictive policy stance, but warned that interest rates could need to rise if progress on lowering inflation stopped, potentially due to stronger than expected government spending or global supply chain disruptions. This may in turn raise prospects of higher for even longer interest rates, with implications for consumption and investment, the fund said. Finally, in crypto, Bitcoin dropped over 5% this week as the escalating conflict in Gaza and Lebanon fueled flows into safe haven assets. Middle East tensions are driving a sell-off in risk assets, including Bitcoin. Additionally, the Bitcoin US dollar faced bearish pressure as stronger than expected US labor market data and Federal Reserve Chair Jerome Powell's hawkish remarks supported the US dollar's recovery from its lows. Another factor putting downward pressure on Bitcoin is the outflow of funds from Bitcoin exchange-traded funds, which has continued for the third consecutive day. US spot Bitcoin ETFs saw net outflows of $51.13 million on Thursday, marking the third straight day of negative flows, totaling over $388 million. It was last at 62,376, up 1.14% on the day. So standing back, you can see here that the tides are definitely on the turn, and some of the global geopolitical issues are coming to the fore on one hand, but on the other, the US economy still seems to be doing very well, which suggests that maybe rate cuts won't be coming anytime as quick as expected. So in that context, markets are confused, and I think will remain so. Expect more volatility, more ups and down, and more bad international news in the weeks ahead. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.